is Doug Clelan, one of the owner advisors of Clelan and Company. I thought I would take the next few minutes to talk about what can be a very confusing set of rules around distributions from a traditional inherited IRA. Your first question might be, what is an inherited IRA? Well, in simple terms, an inherited IRA is one in which you are named as the beneficiary. It is important to distinguish between an IRA inherited from your spouse versus, say, for example, an IRA inherited from your sibling. For most of us that are married, we are the beneficiary of our spouse's IRA. There are more options available to you when a spouse passes away. An important first question is, was your spouse the original owner of the IRA? Let's assume that your spouse was the original owner as contrasted with your spouse inheriting the IRA from parents or a sibling. The next question is, did your spouse pass away prior to the required beginning date? To clarify, the required beginning date is the date that the deceased spouse would have been required to begin taking RMDs or required minimum distributions. If the answer is yes, then if you are age 59 and a half or older, and you are older than your deceased spouse, you should consider making the election to be treated as your deceased spouse. The advantage here is that based on Secure Act 2.0, required minimum distributions are delayed until the age your deceased spouse would have needed to begin taking distributions. A quick example. You are 65 and your deceased spouse was 62 in 2024, the year of death. The start date for your RMD normally would be at age 75 in 2034. By choosing to be treated as your deceased spouse, you delay required minimum distributions until the deceased spouse would have reached age 75, in this case 2037. For some folks, delaying RMDs helps with their long-term financial security. So what if you are younger than 59 and a half and you want income now? In this case, you should consider inheriting the IRA, as distributions from an inherited IRA are never subject to a penalty. The penalty refers to the 10% surtax on distributions prior to age 59 and a half. There are a number of other possible scenarios, which is why we are providing a link to a flowchart that can assist you in making an appropriate decision should your spouse predecease you and have named you as the beneficiary of their IRA. So let's turn our attention to another important question. How must I take distributions from a traditional inherited IRA? We just reviewed how distributions from an IRA inherited from your spouse work, but what if the IRA is from a non-spouse? The first question to ask is whether the owner of this IRA passed away after December 31, 2019. Since this is 2024, let's assume the answer to that question is yes. At this point, you either qualify as an eligible designated beneficiary or you are a non-eligible designated beneficiary. As you might have surmised, the distribution rules are different. To achieve the status as an eligible designated beneficiary, you, at the time of the owner's death, would need to be either a minor child of the owner, less than 10 years younger than the owner, be disabled or chronically ill. Obviously, there are many circumstances where beneficiaries qualify as an eligible designated beneficiary, but probably far more where the beneficiary is a non-eligible designated beneficiary. If the deceased owner passed on or after the required beginning date, you must follow the 10-year rule, and you must also take RMDs over the longer of your life expectancy or the deceased owner's life expectancy. Well, what if the deceased owner passed away prior to the required beginning date? Then you must follow the 10-year rule and make sure that the entire account balance has been withdrawn by the end of the 10th year after the year of the original owner's death. In this latter case, you would need to be aware of a potential tax trap, in that the 10th year could result in a large distribution that could impact your tax bracket, your adjusted gross income, and your IRMA adjustments to Medicare premiums. So, what seems like a simple thing, an IRA owner passes away and you are the beneficiary, can become quite complex with significant impact on taxes, Medicare premiums, and cash flow. As advisors, we are tasked to be aware of these nuances in light of your overall financial plan and in conjunction with your accountant help you to navigate these decisions. As mentioned, we have provided links to some flowcharts that are designed to help you understand these important decisions. As always, it is our purpose and our passion to help you build your financial success. Please give us a call if you recently inherited an IRA or would like to discuss the beneficiary designations on your own IRA accounts. There is much to gain by doing this right and much to lose in making the wrong choices. Thanks, everyone, and I hope that you benefited from this brief summary. Thank you very much. Brief summary. Much.